In 2008, a man walked out of his office for the last time, carrying nothing but a briefcase and the weight of $65 billion in losses. He didn't rob a bank. He didn't hack a system. He didn't even technically break the law for most of his career. His name was Bernie Madoff, and he ran the largest Ponzi scheme in human history by doing something almost embarrassingly simple. He paid early investors with money from new investors, called it returns, and repeated that for nearly 30 decades. But here's what makes this story different from every other fraud documentary you've seen. Madoff didn't just steal from the rich and stupid. He stole from Nobel Prize winners, Hollywood directors, charities, and financial professionals who built entire careers analyzing risk. People who should have known better didn't just miss the red flags, they ignored them on purpose. Because the system he exploited wasn't a bug, it was a feature. Let's start with what a Ponzi scheme actually is, because most people get this wrong. It's not a pyramid scheme. Those require you to recruit people. A Ponzi scheme is simpler and somehow more elegant. You promise investors a return, let's say 10% a year. You take their money, but instead of investing it, you just hold it. When they ask for their returns, you pay them out of the pool. And as long as new money keeps coming in faster than old money goes out, the whole thing works. It's a magic trick, but the trick only works if no one asks to see behind the curtain at the same time. Madoff started his firm in 1960 with $5,000 and a legitimate business model. He traded stocks. He made markets. He helped build the NASDAQ. For decades, he was one of the most respected names on Wall Street. Former chairman of the NASDAQ Stock Exchange, sat on SEC advisory committees, gave lectures at universities. Then, at some point in the early 1990s, he stopped investing client money altogether. No one knows exactly when, not even his own family, apparently. He just started running the scheme. His pitch was boring, not sexy, not flashy. That was the genius. He promised consistent, moderate returns, 10 to 12% annually, every year. No massive gains, no losses, just steady, predictable growth that made absolutely no sense if you thought about it for more than 30 seconds. Because markets don't work like that. Markets go up and down. Even the best investors in the world have bad years. But Madoff's fund never did. It went up in 2001 when the dot-com bubble exploded. It went up in 2002 when the market collapsed. His returns looked like a heart rate monitor for someone who was already dead, and people loved it. Here's where it gets uncomfortable. The people who invested with Madoff weren't naive. They were the opposite. They were sophisticated, wealthy, connected, and many of them had a pretty good idea something was off. But they didn't care, because it was working. There's a term for this in psychology, willful blindness. It's not that you don't see the warning signs, it's that you choose not to look. Because looking means asking questions, and asking questions means the money might stop. One investor, a French fund manager named Thierry de la Ville-Luchet, put $1.4 billion of his clients' money with Madoff. When the scheme collapsed, he locked himself in his office and slit his wrists. He left a note apologizing. Another red flag, Madoff's auditor was a firm called Freeling and Horowitz. It had 3 employees. One was a 78-year-old secretary. One was retired and living in Florida. The third was the accountant, David Freeling, who later admitted he never actually audited anything. He just signed the papers. This firm was supposedly auditing a fund managing $65 billion. For context, Bernie Madoff's operation handled more money than the GDP of Luxembourg, and it was being audited by a guy working out of a strip mall in upstate New York.
The SEC investigated Madoff multiple times. In 2005, a financial analyst named Harry Markopolos handed them a 21-page report titled "The World's Largest Hedge Fund is a Fraud." He showed them the math. He explained why the returns were impossible. He practically begged them to shut it down. They thanked him and did nothing. Because Madoff wasn't just connected, he was the system. He helped build the infrastructure of modern electronic trading. He advised the people who were supposed to regulate him. Shutting him down would mean admitting the referees had been asleep for 20 years. So how did it all end? The same way every Ponzi scheme ends. The music stopped. In 2008, the financial crisis hit. Investors panicked. They wanted their money back, all at once, and Madoff didn't have it. He never had it. On December 10, 2008, he told his sons the truth. They reported him to the FBI the next day. Within 48 hours, federal agents arrested him at his apartment in Manhattan. He was calm, almost relieved. He told them, "I paid investors with money that wasn't there." The final tally was $65 billion in reported account balances. The actual amount of cash that went into the fund was closer to $20 billion. The rest was phantom returns, numbers on paper, a collective hallucination that lasted nearly 30 years. Madoff pled guilty to 11 felony counts. The judge gave him 150 years in prison. He died behind bars in 2021 at the age of 82. But here's the thing. Madoff didn't invent this. He just perfected it. The original Ponzi scheme was run by a guy named Charles Ponzi in 1920. He promised 50% returns in 90 days by exploiting postal reply coupons. It collapsed in 6 months. Madoff's lasted 30 decades because he understood something Ponzi didn't. Greed is sustainable if you keep it reasonable. Don't promise the moon, promise 11%. Don't target widows and retirees, target hedge funds and billionaires. Don't act like a con man, act like the most boring accountant alive. Wear nice suits, sit on charity boards, make everyone feel like they're part of an exclusive club. And whatever you do, don't let anyone look under the hood. The question you should be asking isn't how Madoff got away with it for so long. It's how many smaller versions of this are happening right now. Because Ponzi schemes don't disappear, they adapt, they migrate. In the 1920s, it was postal coupons. In the 2000s, it was fake investment funds. In the 2020s, it's crypto tokens with no underlying value. NFT projects that promise utility and deliver nothing. Influencers selling courses on how to sell courses. The structure is always the same. Early money pays late money. Hype covers the math, and everyone pretends it's sustainable until it isn't. Here's the deeply uncomfortable part. Madoff's scheme only worked because the people around him wanted it to work. Investors ignored warnings because the returns felt good. Regulators ignored warnings because Madoff was too important to fail. Accountants signed off on audits they never performed because everyone else was doing it. No one wanted to be the person who asked the obvious question, where is this money actually coming from? And that's the real lesson. Fraud at this scale isn't just about one man lying for 30 years. It's about thousands of people choosing not to see the truth. It's about a system that rewards performance over process, returns over reality, the appearance of success over actual success. Madoff stole billions without breaking the law for most of his career because the law was designed by people like him. He sat on the committees, he advised the regulators, he built the machine, and then he gamed it. When he finally confessed, investigators found something strange in his office, a life-size cardboard cutout of himself. No one knows why it was there. Maybe it was a joke. Maybe it was a reminder. Maybe at some point, even Bernie Madoff couldn't tell the difference between the man and the performance. The victims are still fighting to recover their money. As of today, a court-appointed trustee has clawed back about $14 billion. That's roughly 70 cents on the dollar for the actual cash people put in, not the fantasy returns, the real money. Some people got out early and made a profit. Technically, that profit was stolen from the people who came later. Some of those early investors had to give the money back. They sued. They argued they didn't know. Maybe they didn't, or maybe they just didn't want to. The uncomfortable truth is this. For every Ponzi scheme that collapses, there are probably 10 more quietly running in the background. Smaller, smarter, better hidden. And the people running them learned from Madoff's mistakes. Don't get too big, don't stay too consistent, and whatever you do, don't tell your sons. So here's the question you should sit with. If you were offered consistent, above-average returns with no clear
explanation of how the money was being made, would you ask questions? Or would you just take the check? Because the scariest part of the Madoff story isn't that one man lied for 30 years. It's that thousands of people heard the lie and chose to believe it anyway.